outlook. Lata is joining in with more details on that. Lata, over to you.
Yeah, the big number is the headline inflation, which is expected to come over 7.08 according to our poll. Now, even this is bad because the year ago figure in August was also 7. So for 2 years in a row, if you're going at a 7% average, that itself is not a good number. One hopes it is transient. Now, remember, of course, the RBI and the MPC's mandate is to keep inflation 4% plus or minus 2%. That is, they have to keep it at between 2 and 6%. So this is way, way above their mandate. Now, the culprit, the positive is that core inflation, which is usually a sticky thing, is not doing too badly. It's down to 4.8. Last month, it was 4.9. Year ago, August, it was 5.9. So fairly good progress in that point, but not in the one that's really pushing it up, which is food, expected to come again in August at a double-digit number of 10%. In July, it was 11.51, so that may look like a bit of a solace coming from maybe tomato prices, but there are sticky cereal elements in that which will be worrisome. So that will be looked at. You know, what elements in the food inflation are high? Is it vegetables or is it cereals? If cereals has gone worse than the 13% that they were in July, that will be bad. And finally, you should remember that the July inflation at 7.44 had come against an expectation of 6.6. You know, that's what threw the entire market out of its wits. Now we have to see whether it comes out of kilt with what was expected, 7.08. If it is way above that, then you must expect that the Reserve Bank will get far tighter. Chances are it could be a little lower, in which case perhaps it's going to be status quo. But in any case, the Reserve Bank will remain in liquidity tightening mode. Just one word, there is also an industrial output number coming in for July. And that's expected to come in at 5.2%. And that would be a little better than the June number. But let's see.
Okay, all right, Lata, thanks very much for that. So busy evening on the macros today. But let's get in a technical check. We have Sachidanand Uttikar of Trade Bulls who's joining in on the show. Sachidanand, welcome to the show. Well, the big talking point is definitely the weakness that we've seen in the mid-caps. So what would you recommend to, say, a retail investor who wants to now enter stocks such as SJVN, RVNL, which have seen strong runs but are seeing sharp declines today?
Good afternoon, Ekta. Already we have seen a very strong rally in majority of the mid caps. But even right now, this kind of shakeout which we have seen since morning, I think the focus again has come back to some of the large cap names. So if you look at from a market perspective, the trend has been very strong. Within a span of 7 trading sessions, we are back above that 19,900 mark. And if you look at the entire structure, still, we see, this particular, trend getting extended towards 20,200 to 20,500 during this particular series itself. So from a market perspective, I think after a strong rally, probably a good consolidation may be on cards, but there is clearly no sign or any distortion or exhaustion yet. So until unless Nifty is trending above that 19,830 mark on a closing basis, we still believe that there is scope for an extended move towards 20,200, which could be seen during this particular week itself. And we may see this particular rally getting extended towards 20,500 at the end of this particular series. So we are optimistic on the market. In fact, Nifty Bank, which was underperforming since last couple of weeks, it has started picking up. We have ICICI Bank, which yesterday broke out from a 14 days of consolidation. We have HDFC Bank, which has been, consistently adding long positions here since the breakout at around 1600. So I think the focus still remains on the banking pack, and we may see, banking stocks again, leading from the front. So we are expecting with the markets to trend higher. 20,200 is something that we are watchful of for this particular week. But eventually we see Nifty, scaling towards 20,500.
Okay, thanks a lot for that. Well, eventually the Nifty is all set to move higher, but the mid-cap index for now is seeing its biggest single-day fall for 2023. But thanks, Sachidanand, for joining us. Let's listen into a host of important market opinion that came in from Atul Suri, Sunil Singhania and Vijay Kedia. We'll come back.
I feel where the market is heading or what my targets were, I see that there is still more upside going ahead. As I said, there's a lot of panic, there's a lot of talk of bubble, and there's a lot of talk of all that. I don't think we are anywhere near bubble territory. I think that there is more upside. And what I say is that you've seen 11% and you're like getting so this thing that we can have another 8, 10, 9, 10%, you know. And a lot of people say that, oh, you want to sell out this segment, we should get out, blah, blah, blah. You never know. You could be missing a more interesting part in the market. So there were these numbers being put up like that. Let's say Nifty is up 10, 11%, small cap index up 30, 33%. So 1:3, that's big. So we do something called a ratio chart. A ratio chart is where we compare one index versus another, and it's not from a starting date. The risk is the starting date. So now if you move your starting date from 31st March to maybe 2 years, you'll realize that actually what the small cap is doing is catching up with the underperformance of 2022.
Clearly believe that in the near term, there is now catching up to do from the large cap side. I think when you look at stocks which offer you value on fundamental basis, more large caps pop up than the micro caps and the small caps. I think there's a lot of fear of missing out, a lot of momentum, a lot of theme-based investing, particularly from the mass retail, which is happening on the smaller companies. And I would really believe that it is time now for the large caps to do some catching up. And Nifty at like less than 18 times P clearly offers more value than some of the smaller companies.
These PSUs and all those railway stocks and defense stocks and all. Let me tell you, I personally find them now very expensive. Okay, beyond imagination, they are expensive. So people should understand, people should always remember. See, if your view is for 10 years, like Sunilji said, India story, if you are really playing India story, that means you are playing for a decade. Then it is all right. But you are talking about India story and playing about T2T story or BTST story or 6-month story, 3-month story, then you are in problem. Then you should remember, as I always say, that Rome was not built in a day, but Hiroshima and Nagasaki were destroyed in a day. So this is what people should be very cautious.
Okay, some amount of caution coming in there. We need to take a short break, but we'll be connecting with Abhishek Somani, who's the MD and CEO of Somani Ceramics, to discuss their business. Stay tuned.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
आप सबकी सहमति से आगे की कार्रवाई शुरू करने से पहले मैं अफ्रीकन यूनियन के अध्यक्ष को G20 के स्थायी सदस्य के रूप में अपना स्थान ग्रहण करने के लिए आमंत्रित करता हूं। Excellency.
For what, the third month running, minus 2.7, and consumer non-durables up 7.4, which is a positive. Okay, I think I've blurted out a whole host of numbers. Let me welcome my guests. Aditi Nair, Chief Economist at ICRA, Nikhil Gupta, Chief Economist at Motilal Oswal Financial Services, and Rupa Negeditsure, Chief Economist at L&T Financial Services, and of course, one of the authors of the inflation targeting report led by Urjit Patel. Rupa, I will have to start with you. Okay, we are also being joined by R. Sivakumar of Axis Mutual Fund in a bit. But first to you, Rupa, what's your sense of this inflation number, 6.83, better than expected?
Certainly, it's better than expected, but I think we are looking at everything in relative terms. We should not forget that RBI's upper tolerance limit is 6%. So it is much higher than that. So, they will still wait and see how it pans out. Because as they have been saying, they are able to control now inflation through a lot of supply side measures. But I feel the way now we are seeing, inflationary pressures building up in cereals and products and pulses, it has potential to make the whole phenomenon more structural rather than cyclical. And RBI will certainly remain vigilant about that, given the, unevenness in monsoon rainfall and the fact that, water reservoir levels are depleting every passing week. So, it's not just the concern about the Kharif, but at this stage, they will even think in terms of the outlook for Rabi crops.
Okay. No, your point is taken. Reserve Bank has said in the past that while vegetable inflation is transitory, cereals inflation does tend to be a bit sticky. Let me also welcome Madhavi Arora. I'm sorry I missed you out, Madhavi, but just coming to you in a minute. Aditi, your first thoughts? Is the inflation picture looking better than you feared? I mean, it's not per se a good number, but is it better than you feared?
Thanks, Lata. Certainly, it has come in 10 basis points below what we had penciled in for today. So, in that sense, it is a relief. It's confirming that at least tomato price spike, as expected, was transitory. But there are so many looming concerns on the food inflation side that it's hard to really be too optimistic with how things are evolving. We are expecting the next CPI print to be below 5.5%, but even with that, the quarter as a whole is going to exceed the MPC's forecast. So caution is not going to go away from their tone anytime soon. And I completely agree with Rupa that we're moving from a crystallization of all the fears that we had for the Kharif crop to now beginning to get quite concerned about what lies in store for Rabi. So not the best of food inflation situations overall, but of course a relief for now that the core components have come in below what we were expecting.
Okay. Okay, my only point is that when I was taking the poll, all of you knew about the El Nino, all of you knew about the reservoir levels, and we still have a number which is a good, 25 basis points lower than my poll. And that goes for Nikhil, you as well. Your number is very close to our polls at 7.1, and this is like 27 basis points lower. Will you redraw your inflation forecast for the year? Are you less worried?
Hi, Lata. So yes, we are happy that the number is below 7%, but if my understanding is correct, it is entirely because of vegetables.
Yes.
We penciled in a deflation of 1% month over month in vegetables, but daily prices were showing higher inflation. I think it's very difficult to forecast because even when the numbers are out on daily basis, because last month daily prices were showing minus 50% and in CPI it was minus 35%. So we do not get data for all vegetables, and that is why it is so difficult to predict it. And that is why, although I mentioned 7.1%, we always said there is a downward bias to those numbers. And there is no as such relief from the future month numbers because it is entirely because of vegetables. Okay. It is very clear that pulses, spices, crude oil prices, these commodities are seeing higher inflation. Cereals have been in double digits and will remain high in the foreseeable future as well. So actually, we have revised up our inflation numbers considering what happened last month, that is July. And even though August is slightly lower than this, our inflation now is higher than what we were expecting a couple of months back for this year. Okay. And we do not see, you haven't asked, but for September, we do see inflation at somewhere close to 6% or so.
Oh, 6% for the full year.
For September.
For September. What's the full year number? 5.4?
For the full year, we are close to 5.5, yes.
5.5, okay. Madhavi, what would your thoughts be? Are you going to revise your number? Where do you stand at in terms of full year now, and will you revise it?
So honestly, as Nikhil also mentioned, that there's a lot of volatility in the data. Every week is a new week for us in numbers. At this point in time, we are tracking next month's data close to on 6.1%. We'll also have the effect of lower LPG prices, which will be felt in the month of September, and also the vegetable prices are tracking much lower than previous month, obviously led by tomatoes, while onions are still a problem. And as most of the panel guys suggested, we are seeing perishables being non-perishable being still a problem. The persistence of non-perishable, which is led by pulses, cereals and spices to that extent, it's probably going to be continuing as we get into the latter part of next quarter. So I think next month we are looking at a 6.1%. Overall for the year, I still think that we are close to a 5.3-ish. And I think core inflation would be undershooting headlines by roughly 40-50 bips this year.
Okay. Got that. So the RBI's inflation number for the current quarter will have to be revised higher anyway from what they told us in June. What they told us on August 10th. But we'll come to that in just a minute. Sivakumar is really the man of the moment because the bond market should be exhilarated. They were all preparing for a 7% plus number. This is 6.8. So, Shivakumar, do we get some bit of a rally in bond prices, or will you all keep looking at the US 10-year?
There's a lot to unpack here, right? I mean, I think, firstly, absolutely, this is a good number. I think markets were expecting a range in line with your poll, somewhere a little north of 7%. The fear would have been there if this is printed at 7.5, right? So clearly, the fact that it's printed below 7 will give a little bit of comfort to the market. But I think the market's, as always, forward-looking. This month-on-month volatility in vegetable prices. What can the MPC, what can interest rates do to react to 1 month's vegetable trend? Right? So you have to look at a little bit medium term. And I think that's the worry the panel has expressed on things like reservoir levels leading up to fears that we may develop over a period of time. What will happen in the Rabi, etc. So the persistence of inflation, I think, is going to be more of a problem than this, couple of months of spike in inflation. I think if it becomes a persistent problem by the end of this year, early next year, when the Rabi crop comes to market, we have a serious issue at hand. Because I think from a market's perspective, as we've previously discussed, there is no rate cut expectation being built up at least for the next several months into middle of next year. So it's not that the markets are going to be disappointed in some sense with what RBI is going to do. But if inflation remains high going into the new year, we may need to reevaluate what monetary policy will look like middle of next year. And I think that will then start to worry all of us. I think that is going to be on people's minds as we go to months forward from now. Certainly the Fed and other factors are in play. But come on, 10 years at 7.27 quarter levels, a lot of those risks are priced in.
Okay. Well, already the one-day call and the tripartite repo are all, above 6.5. Today, I think 6.7 almost, 6.68 thereabouts. Do you think Reserve Bank relents in terms of giving us more money towards September 15th, as was expected, and we see it move towards 6.5? Now that you're not crazily worried about inflation, will they allow it to come closer to 6.5 and occasionally below?
It seems to be, this ICRR and the fact that they have let it run forward suggests that they are more comfortable if the overnight rate starts moving closer to the MSF than if it stays at repo. And certainly very, very uncomfortable if it dips below repo. So the bias is to keep rates higher. So this is basically a way of kind of signaling a hike or hiking without hiking, right? So I think that is very clear that and this is an off MPC decision. So it's not that the MPC really feels that they need to make a repo rate decision. This is more about the RBI then wanting to keep liquidity tight and rates probably hugging the MSF to sort of push a downward pressure on the economy. So I think I don't think the RBI wants to hike because that's too strong a message, but this is a kind of an indirect way of keeping liquidity tight.
No, no one's talking of hike. I mean, they won't do that perhaps, but...
I would say that keeping liquidity tight through this kind of a liquidity, the ICRR type of a
And
measure.
still closer to 6.75, you think?
Yeah, if you're pushing it to 675, for practical purposes, if that is going to be
That's
your
a
new
hike.
benchmark, it's almost as good as. So I think the signaling effect is not there as much as a repo hike, but the practical effect in terms of pushing rates higher, right?
To be fair, the weighted average is 6.75 even today. It's only the close is 6.67 or 6.63. Otherwise, the weighted average, RBI has effectively pushed yields by about quarter basis point. Let's dwell a little bit on the growth number as well. Not that it is the best of growth indexes that you economists track, but nevertheless, 5.7, does that look like a good number, Nikhil? I mean industrial output for July.
Yeah. So Lata, we were expecting higher number, especially considering the fact that core growth was 8% plus, and there was this base effect as well. Last year, this month was 2% as against much higher in the previous month.
Okay.
So we were expecting close to, I think, 8% IIP this month. So we are disappointed, but I understand the consensus was much lower and it has turned out to be better than consensus. So I don't think markets have anything to worry about. But I still believe that for the next 3 months, IIP could turn out to be much better than even July numbers because of the base effect and because we have festive season coming up.
Yeah, and there's electricity is done very well, and we see very clear policy efforts also to keep electricity in ship shape. That perhaps also is helping. Rupa, what have you made? Okay, I just wanted to tell you all the core inflation 4.8 is what the Cogensis calculation is. I have got another economist telling me, no, it's 4.86. So core has dipped, but not by a great deal. It's not a seminal fall. It's just crawled lower. Well, Rupa, you want to say anything about core and then, of course, IIP?
Yeah, core is in line with my expectations, and I think that definitely the monetary tightening so far has played a great role. So far as IIP is concerned, Lata, definitely this is a good number, but this was expected because we had seen, very good growth print for core industrial output, which has a weight of 37 to 40% in IIP. But there also, you see, we are seeing a particular pattern because this growth is primarily driven by central government's capex spending, and that's why you are seeing good growth numbers for infrastructure, construction, primary goods, etc. And we are also seeing the small scale and medium enterprises which are part of the supply chain for these infrastructure industries. They have also been doing well. But when it comes to other sectors of manufacturing, like consumer goods, etc., I'm clearly seeing stresses in urban consumption. And what economists have been talking about, the K-shaped recovery, I think it's getting reflected very strongly. At the higher end, we are seeing good demand, but if you look at the typical consumption basket of middle class or low middle class people, then definitely there is a shrinkage of consumption. So you are seeing, for majority of the months in past 1 year, we are seeing consumer durable growth in negative zone. And consumer non-durables, which is a good proxy for rural demand, there now the picture is very uncertain because of, very skewed monsoon rainfall. And most of the sectors and industries whose growth is driven by rural demand, they have already started giving caution on that front, such as FMCG or auto or, even consumer durables firm, which have a very large exposure to rural markets.
I agree with you, but at the moment, the consumer non-durable number is good at 7.4, but this is a huge base effect. It was minus 2.9 year ago, same month, and therefore the July number technically would actually have been up only 3%, but because it is adjusting for a minus 3 of last month, year ago, it just looks like an impressive 7.4%, but worries are taken on board. Aditi Nair, will you change your inflation number and your growth number?
So, Lata, inflation for the full year, we're at 5.4%, and since the growth number was only 10 basis points below our expectations, so that's really going to have a negligible impact on our full year number. So not changing that. On the growth side, the IIP number has come in well above our 5.1% expectation. And if we look at the high frequencies, then we do expect that the momentum is looking stronger for the next month, and we're expecting a print between, I would say, at least 6 and 7% for the subsequent month.
Okay.
Overall, I quite concerned about a couple of factors that could lead to a slowdown in growth in the second half of the year. The monsoon and its wide-ranging ramifications we've already talked about. That's certainly going to make rural demand quite cautious, pull down agri growth itself, and have an impact on the downstream sort of industries and demand. And also we are somewhat just watchful that higher government spending in the earlier part of the year it's probably an attempt to make sure that the budgeted targets are not missed by a wide margin. But possibly this does mean that we should be prepared for a slowdown in spending towards the end of the year as a model code of conduct comes into place.
Oh, absolutely. Absolutely. Aditi, there is a special session coming up. I wouldn't be surprised if there's something on elections over there. Something that hints to advancing the election, and then we have, the whole budgetary spending would be another math altogether. So let's not even get there. But at the moment, CapEx is a little lower, but infra is very good, indicating both state and central government spending. Madhavi, last thoughts. We are just winding down the show. Anything that you want to comment on in terms of industrial output or inflation?
Yeah, I think on inflation, we are not changing our forecast as yet. We are looking at around 5.3 for the year on headline. And for core, again, we're expecting, somewhere close to a 4.7%. There could be a marginal upside there, given the fact that this month's core has surprises from the upside. But I think overall, one has to reckon the fact there has been a consistent, slower, persistent the overall core inflation getting relatively easy in second half of the year. And I think RBI would take cognizance of the fact that there is a demand destruction that is taking place. And if you look at even the PMI numbers, it is clearly showing that there is some erosion in the pricing power of firms, because input prices have been rising much faster than output prices. So I think for inflation, I don't think it's a big worry on net basis. On growth, I think we continue to believe that we'll probably be seeing a sub 6% GDP growth for the year. While at this point in time, I think there is sentiment around manufacturing which is still looking positive.
Okay.
We are seeing headwinds from the global growth point of view, but I think domestic demand will be the anchor for this year. If at all that doesn't really pick up, we will be seeing a bigger problem on growth front. And I think we are of the view that domestic demand will remain sluggish. We are seeing rural demand remaining tepid. We'll also see probably falling income growth in the urban sector, and also probably profitability of corporate sector also shrinking to some extent.
Yeah,
and more
but
importantly, I think
Madhavi, it's just that the stock market is not listening to us. The stock market is on another plane, and today they are going to absolutely welcome these numbers. Everything is a delta. If the delta is that inflation is lower than expected and growth is slightly higher than expected, tomorrow we have all the makings of positivity, both for the bond markets and for the stock markets. This is a pleasant set of numbers. No taking away from the longer term or the medium term red flags that all of you have put on the table. But for tomorrow, the markets have something to cheer, provided the US doesn't take away what the Indian data has given us. In any case, the bigger data is going to come on Wednesday and Thursday, the PPI and CPI numbers from the US. So I think that will take away the limelight. But for the moment, the state of the economy news from this set of data is positive.